How whales manipulate the market, and you don't notice every time the crypto market moves, there's a story behind it. But it's not the story you think. See the price go up and you think, momentum. You see a crash and you think, panic. But what if I told you that every major move you've ever witnessed, every flash crash, every parabolic run, every fake breakout, wasn't random at all? What if it was all engineered? It's by a small group of invisible players who control billions of dollars and the emotions of millions of people. They're called whales, and they are the true architects of the crypto market. While most traders react, whales create reactions. They move the market the way a puppeteer pulls strings, slow, quiet, precise. And by the time you realize what's happening, the show is already over. Here's the truth no one tells you. Crypto isn't just decentralized finance, it's decentralized psychology. When whales are the psychologists, they study your patterns, your fear, your excitement, your tweets, your FOMO. They know when retail traders get greedy. They know exactly when you'll panic sell. They don't just buy dips, they create them. They don't follow trends, they start them. Every pump you've ever chased was probably a setup. Every dump that made you rage quit the market was probably a trap. You see chaos, they see strategy. You see emotion, they see liquidity. The market is their playground, and you, the retail trader, are the liquidity they feed on. And that's not an insult, it's a design. Because for every winner in crypto, there has to be a loser. Every big profit needs someone on the other side of that trade taking the hit. Think about it. When Bitcoin suddenly drops 10% in an hour, and headlines scream panic, who's buying all that fear? When a meme coin skyrockets overnight, who was already in before it trended?
And the craziest part, you can actually see them. Their moves are recorded on the blockchain. Every transaction, every transfer, every massive buy or sell. The evidence is all there. But most people don't look because the game isn't to hide the manipulation, it est to distract you with noise. Tweets, influencers, hype all designed to keep your eyes off the real moves. So in this video, we're rediving deep into the invisible game of crypto whales, how they manipulate the market without breaking a single rule, how they control price action through emotion, and how you can finally start spotting the patterns before they play you. Because once you understand what the whales are doing, you'll realize the truth. The market isn't random. It's strategic. The moves aren't emotional. You are. And the people who control that emotion control everything. The deeper I went into the crypto market, the more I realized something was wrong. Prices weren't just moving. They were being moved. Every chart I stared at, every sudden pump, every violent crash. None of it behaved like a natural market. Patterns repeated too perfectly. Timing lined up too precisely. And the more I traced those patterns, the more I kept running into the same thing. Massive wallets moving massive amounts of money at moments that didn't make any sense unless you understood the game they were playing. That's when it hit me. Retail traders weren't trading the market. They were trading the reactions created by a handful of whales that had already planned their next move. When you finally see that, you can't unsee it. It usually starts in silence. While most traders are panicking or celebrating, whales are collecting information order books, funding rates, liquidity pools, fear, greed, and the psychology of the crowd. They don't need flashy indicators or complicated strategies. They watch the market like predators watching their prey, studying the moment when retail makes a mistake. And the moment retail does, whales strike. Not fast, not loud, not recklessly, quietly, efficiently, and always in a way that makes them look invisible. I remember the first time I caught one of these moves happening in real time. Price was climbing slowly. Volume was low. Everything looked normal. But underneath that, whale wallets were quietly accumulating thousands of coins at prices nobody was paying attention to. And within hours, the price exploded. People called it momentum. Some said it was bullish sentiment. But the truth. The pump started long before the pump happened. Whales manipulate market direction. With patience, the average trader doesn't have they buy when the entire market is bored, doubtful, or bleeding. They don't chase green candles. They create the conditions for green candles to appear later. That's the first part of the manipulation accumulation during what looks like nothing happening. Most traders get impatient and sell. Whales take those coins, and then they wait. They wait for the market to reach an emotional breaking point, and they push just enough liquidity to trigger a reaction. Once retail believes the price is finally moving, they jump in. And that's when the manipulation begins to pay off. Because whales don't just move the market, they move you. The next level of manipulation is something most traders never even notice. Engineered dips. Whales understand exactly where retail places their stop losses. They know the zones where people panic, and they know the exact points where leveraged positions get wiped out. So they target those areas. It took me years to realize that many sudden crashes weren't actually caused by fear. They were created to cause fear. Imagine you're watching Bitcoin at a key support level. Everything seems stable. And out of nowhere, the price nukes 5% in 30 seconds. People freak out. Traders close positions. Leverage gets wrecked. Panic spreads, but behind the scenes, a whale just sold enough to trigger cascade liquidations, then bought everything right back at a discount. The crash wasn't a reaction. It was a strategy, and it goes deeper than just stop-loss hunting. Whales use fake volume to lure people in. They create buy walls, then remove them. They push price into liquidity pockets designed to trap impatient traders. They use derivatives to control the spot price. And they do all of this without breaking a single rule, because these aren't illegal moves. They're strategic ones. Moves designed around the psychology of millions of traders who all behave predictably under pressure. If you've ever felt like the market was moving against you personally, like it was waiting for you to enter before reversing, that wasn't your imagination. That's how the system works.
Then there's the media factor. Most retail traders don't move based on charts. They move based on emotions triggered by news. Whales understand this better than anyone. It's why you always see the same pattern. Bullish news appears after whales accumulate, not before. Bearish news drops after whales distribute, not before. Sentiment isn't random, it's shaped. You get excited once whales already made their move. You get scared once they want cheaper coins. You think you're reacting to news, but you're reacting to a narrative designed to move liquidity from one pocket to another. I've watched this play out over and over again. A whale buys right before a rumor. Price pumps. Retail FOMOs, whale sells into the enthusiasm. News then changes. Price drops. Retail panics. Whale buys back. It's a cycle so clean it looks scripted. Here's where things get even darker. Whales don't operate alone. Exchanges play their role too. Order books aren't neutral environments, they're battlegrounds. Spoof orders appear and disappear. Bots front-run retail entries. Massive limit orders flash for a split second to fake confidence or fake fear. And when you combine whales' liquidity with exchanges' technical edge, the market becomes something completely different from what most people think. It's not a fair game. It's a game with an entirely different set of rules. Retail traders are never told about. But even with all this power, whales aren't invincible. They still need one thing: liquidity. They need millions of traders acting predictably. They need emotional reactions. They need fear and greed. Without retail, whales can't profit. And that's the part that most people miss. Whales don't manipulate the market because they want chaos. They manipulate the market because they know exactly how predictable human behavior is. The real manipulation isn't just happening on the charts. It's happening in the minds of traders who think they're making rational decisions but are actually reacting to conditions whales intentionally created. Once I realized this, the entire market changed for me. I stopped asking why the price moved. I started asking who benefited from the move. And every time the answer led back to the same small group of wallets. I started paying attention to on-chain data, whale accumulation zones, exchange inflows and outflows, funding rates before major moves. And suddenly, what used to look unpredictable started making more sense. I saw pumps forming before the candles even moved. I saw crashes coming before the panic even started. Not because I could predict the market, but because I finally understood how whales played the game. The truth is, you can't beat the whales. It's not in raw power, not in liquidity, not in influence. But you don't need to beat them. Just need to stop being predictable. Stop reacting emotionally. Stop trading based on news someone else wants you to see. If you stop being the liquidity, whales lose their advantage, because their entire strategy depends on retail acting exactly how they expect. And once you stop giving them that reaction, you start seeing the market for what it actually is. Not a battlefield you're losing, but a system you can finally understand. And after seeing this play out again and again, I realized something important. Whales aren't superhuman. They're not always right. They don't win because they're smarter. They win because they're patient, disciplined, and completely emotionless. Meanwhile, retail trades based on hope, fear, hype, and headlines. That's the real imbalance. The market isn't built to punish you, it just punishes predictable behavior. The moment you stop being predictable, everything changes. Because once you understand how whales think, their moves stop looking mysterious. You start seeing patterns in places other people only see chaos. You stop falling for fake pumps. Stop panicking during engineered dips. You stop chasing narratives designed to move your money into someone else's pocket. Suddenly you're calm when everyone else is losing it. That's when the market finally becomes survivable. So the next time you see a candle spike or crash out of nowhere, don't assume you're watching randomness. Assume you're watching intention. Ask who benefits. Ask who's accumulating. Ask who's waiting for you to react. Because once you see the game, you can't unsee it. If this opened your eyes, hit like, subscribe, and stay sharp, because the next video exposes what exchanges don't ever want you to know.